Hi, good morning, everyone. Welcome back to Value.Venture. Today, we take the next logical step. We go inside that inventory and reconcile it unit by unit. This is one of the most data intensive parts of construction finance appraisal and also one of the most revealing. Start with the core caution. A project may have 200 sanctioned units, but the lender cannot assume all 200 are available as security or as future revenue. The inventory has to be classified line by line. At minimum, the schedule should identify, for every unit, the tower, the floor, the unit number, the area, the ownership allocation, the sold or unsold status, the agreement value, the collections received, the balance receivable, the mortgage status, and the release status where relevant. That is the raw material of a real CF appraisal. For sold units, here is the technical rule. The future project inflow is the balance receivable, not the full agreement value. Let us put numbers on it. A unit is sold for 1 crore. The customer has already paid 55 lakh. The remaining contractual receivable is 45 lakh. And even that 45 lakh must be read alongside the construction linked payment schedule because it may only become collectible after future construction milestones are reached. Money contractually due is not the same as money imminently collectible. For unsold units, we estimate market supported realization. The developer's price list is only one reference, never the conclusion. We also examine recent agreements within the project, registered transactions where available, competing developments nearby, the stage of construction, the location, and the achievable sales velocity. Then we run three reconciliations. The first is unit count based. Opening unsold inventory plus cancellations minus new sales equals closing unsold inventory. The second is value based. Total sold consideration minus collections received equals balance sold receivables. And the third is security based. Here we separate the units already released by the CF lender, the units still mortgaged, the units belonging to the landowner, and the units otherwise unavailable. Now, the red flags, and in inventory work, they are everywhere. The same unit appearing as both sold and unsold. Landowner units quietly included in developer inventory. Cancelled units not restored correctly to the unsold pool. Receivables shown against units that are actually fully paid. And units already released from mortgage still being counted as primary security. There is one error serious enough to deserve its own mention: double counting. A sold unit's full market value should never be counted as unsold inventory, while its balance receivable is also counted separately as cash flow. That counts the same economic interest twice, and it silently overstates project coverage. Suppose a project shows 50 crore of unsold inventory value and 30 crore of receivables. If some of those are the same units counted both ways, the real figure could be far lower. So, a technically sound inventory schedule is not just a sales annexure bolted to the back of a report. It is the bridge between three things: project valuation, project cash flow, and lender security. If the inventory schedule is wrong, then the gross realizable value, the receivable statement, the security cover, and the repayment model can all be wrong at the same time from the same root error. Now, once we know what is sold and what is still receivable, the next question is about speed. How fast is the unsold stock actually selling, and how fast is the money coming in? That's sales velocity and collection efficiency, and it's what we'll examine in the next video. Please subscribe to Value Venture, and thank you for watching.